Welcome to Cover Book Meet. I'm your host, Roger Nichols. Our guest today is a mover and shaker in the world of finance. Nancy Tengler's career as a portfolio manager spans 40 years. She's currently the CEO and Chief Investment Officer of Laffer Tengler Investments. She is a passionate advocate for women's financial literacy. She leads the firm's Women in Wealth initiative. She is also a sought-after TV and print financial commentator on local and national media outlets. Fortunately, she's been willing to share her financial expertise. A second revised edition of her popular book, The Woman's Guide to Successful Investing, Achieving Financial Security and Realizing Your Goals, was just published in September, and we are very pleased to welcome Nancy Tengler.
Roger, thanks so much for having me.
Were you always going to have a financial career? Did the young Nancy dream of being an expert consulted by Bloomberg, CNBC, and the Wall Street Journal?
Young Nancy wanted to be a fighter pilot in the Navy and, and went through all of the tests and then saw Private Benjamin. Do you remember the movie?
Oh, I do indeed, with Goldie
Yeah.
Hawn. Yes.
Yeah. Where are the condos? That was me.
Interesting. So obviously you've had a great career. Was there a specific incident or a series of incidents that said, let me share that expertise by writing?
Yeah, so first and foremost, I actually became interested in money because I came from a family that didn't have any money. And my father left when I was young, and my mother was working two jobs, then I got a job. And so I went into this career. And then when my kids were entering middle school and high school, I wanted to be home. So I retired and I met all these really smart women that knew absolutely nothing about their financial situation. And worse, didn't want to know anything.
Wow.
And that really inspired me to write the book because, as you know, the statistics show we tend to live longer, and about 95% of women ultimately are going to be responsible for the family finances during their lifetime.
Right, which answers the question I was going to ask next. A lot of people would say, why is there a need for a guide just for women? Don't the investment principles work for both genders?
They do, actually. It's a great question. If you go on Amazon, a lot of the reviews are from men. But importantly, women tend to excuse themselves from the conversation when it comes to investing in particular. They identify as great savers, but they don't like the risk factor because they see investing as gambling or a sport. And so that's why I want them to understand the real principles behind investing, because the research shows that women actually make better investors than men.
I'm not surprised at all.
Well, it's hard to believe because all the storied investors are men, and men make perfectly great investors, but women have a lot of the attributes that make for strong investment performance. But if they're not participating, then there's no use in measuring it. So I want them to participate.
Well, I should mention also, I did mention, I think, in the introduction, this is the second edition of your book. What changes took place in society or the economy that generated the need for an update?
Well, so we had COVID, right? And a lot of women ended up staying home and forewent, some of their peak earning years in taking care of family members. I kind of did the same thing when I left to stay home with my kids. The statistics changed somewhat because more men actually died of COVID than women during the period. It was I have the numbers in the book, but it's something like almost double the amount. And then, they're just different instruments that are available. And I added in this edition, I like this edition a lot more. I added a number of case studies from clients that I've worked with over the years, different stocks, case studies, individuals I've learned from, both good and bad. And so those, I think, really personalize it and bring it home for the reader. But you are correct. The principles are the same. The investing principles are the same for men and women. I just wanted to demystify the language and engage women in the conversation.
And I have a feeling that you're getting a lot of very positive feedback as a result of that.
Yeah, it's funny. Like once women get over their objections and they get comfortable with investing, they are very complimentary because it gives them a lot of freedom. And here's an important thing to think about: the average age of a woman that when she becomes a widow in the United States is 59 and a half.
Mhm.
I was 59. it's a bad time when you're grieving and dealing with everything else to learn how to invest. And because of that, 2/3 of women fire their advisor in the first year. So it really has empowered a lot of the women that come and speak to me after reading the book to be, it makes them a better client, but also to ask questions of their advisor with whom they previously didn't have a relationship with.
Yeah, great. Okay, because otherwise I'll just hand it all to you and not worry about it. Well, I think one of the things that you mentioned in the book is that investment advice or the processing of stuff, the amount of interest they charge can be a real killer.
The fees,
Please,
yes.
thank you. I couldn't come up with a word. Yes.
Yeah, no problem. But it's like interest, it
Mhm.
compounds. The fees are the biggest eroder of total return. And so a lot of people don't realize when they give their money to someone else, they're paying that person a fee. And then, like in our practice, we manage the portfolios, we buy the securities individually. So there's no additional cost. But if your advisor puts you into funds, then you're paying a fee at the fund level too. And
Right.
so the compounding of those fees becomes a really compelling um, detractor from total return.
I had a friend who helped me out early on and said, look at the mutual fund fees you're paying here. These are like 2.5%, 3% by the time they add both, anyway, multiple fees out there.
Coming and going. Yeah.
Yes, yeah. And then
Right.
you have, you've got to stick with it for 7 years before you can have it. I was so glad to get that information because now I'm in places that are a whole lot less. So, yeah.
Right. And we don't, I mean, you're not supposed to be an expert, but
No.
it is important because I mean, if you think about it, this is probably the single most important aspect of your life, which is your financial build for future retirement. And so you really do need to engage with it, as uncomfortable as it may be. And so I have 12 intelligent investing rules in the book to try to really break it down. And the first one is, the biggest risk to women's portfolios is that they frequently don't take enough risk.
Mhm.
And so we talk about that and why risk is okay and good, and that's how you generate total return.
Yeah, good risk, bad risk, and determining that sometimes is not easy, but
Yeah.
that's what you're for. That's what you're here for,
Yeah.
to help them out. And this is another interesting aspect. I mean, you put a lot of fascinating stuff in the book. You told your clients that you're going to retire for 20 years, maybe 30 if you're lucky. And that's not a realization some people just have. They just see across that horizon when I can sit in my lawn chair and drink a beer. And that goes on for a long time. And if you're not prepared for it, you won't be sitting in that lawn chair. Yeah.
Well, that's right. I mean, that's such an important point, Roger, because you sort of strive for the event, and then the event comes and you don't realize, wow, I got 20, 30 years of unemployment ahead of me.
Yeah.
And so that's why I encourage people to continue to take risk early in their retirement years so that they can generate and increase the value of their portfolio. That's why I'm not real crazy about those target date funds, because they make that decision for you and you're not yet necessarily spending all the money when right the day you retire. So you want it to continue to grow.
Oh, absolutely. And I have to get you to tell this story. A personal note that you put in about how not being able to type was a real benefit to you in the long run.
It was funny. I hadn't thought about it for 30. I don't think I ever thought about it. And when I was working on the book, I was snowed in my home in Lake Tahoe. And I thought, gosh, I applied for my first job I applied for out of college was at Bechtel Corporation. And it's the largest privately held engineering and construction firm in the world. And they gave me a typing test.
Mhm.
And which, think about that now, couldn't happen, but
Yeah.
and I failed. And then 20 years later, I was back as the chief investment officer, managing the families and the corporations, billions and billions of dollars. So that full circle had not even occurred to me until I was working on the book.
They did you a favor by
They
in a
did.
strange sort of way. Um, one of the things you talk about in the book is the difference in generational looking how they think about financial. And the millennials have a lot tougher road than those of us in the boomer generation did in terms of like we could afford to work enough to pay our way through college by working summer jobs and part-time jobs. You
Right,
can't do that anymore. Can't
right.
be done. Yeah.
Well, and yeah, that's such a good point. And the millennials came of age when their parents' 401ks were melting during the great financial crisis. So they didn't really have a comfort with investing. I think some of that changed during COVID when they stayed home and, began, even if it was meme stocks, they were in the market and seeing that you can actually generate wealth. But we were coming of age. Remember, we went from pension plans to 401k. So defined contribution plans, we had to make those decisions ourselves. And we were doing it during the booming 90s when, the NASDAQ was up over 800% in that decade. So I think we have an advantage, but they're catching up. I think they're starting to invest more.
Well, they're also making a few mistakes. I think about the GameStop
Yeah. Oh, yeah.
folly, I guess you could call it. Yeah.
I was writing a column for USA Today at the time. They asked me to write an article about meme stocks, and a couple of the younger people that work with me, they said, "Hey, you were all over the Reddit boards last night." Not
Well,
complimentary.
yeah, that was the Reddit people that decided that they were going to go up for this company and pump the stock up, and they did, and a
Right.
lot of them, made a lot of money on paper. And then, of course, like everything, any bubble, it's going to burst.
Right. And that was the point of the article. It works until it doesn't. I
Yeah,
mean, we're glad to have you in the investing world, but yeah.
yeah.
And it
So
turned out to be true.
I, you have different advice that you give to women of different ages. And I love this sharing. What would you share with a girl of 10 or a 20 something or a 55-year-old? How would you split that out?
So I'm going to go reverse
Yeah.
and talk about the older person. I hear a lot from women and actually men that they're too old to invest. And so one of the examples I cite in the book, there's actually two, but one in particular is a woman named Stephanie Muka who made an investment with her husband. They bought a few shares of Medtronic. I think they spent, I don't know, a few $100s. And by the time they sold it 25 years later, it was $460,000, which was a lot of money back then. But then he died and she retired, and she really didn't begin to invest in earnest until she was on a fixed income. And by the time she died, she had given away over $5 million. And so, if you think about that, investing on a fixed income, she was a little bit hardcore. She rented out rooms in her house and she sold her wedding ring and she invested those proceeds. And she did live to be 102. But the fact was, she took the initiative on a fixed income late in life and she made a lot of money. And she had no particular expertise. She had been a nurse. And so she just paid attention, bought great companies. Most of them paid dividends, grew their dividends, and the compounding of that over time generated the $5 million. The same with the other example is a guy named Ronald Reed. He was a janitor and a gas pump jockey. And he, never made much above minimum wage, but he bought blue chip companies, and those are high quality companies that pay dividends for the most part. And he died with $8.2 million in his 80s. So it can be done.
It can be done. In fact, I love this line that you put in. Buy stocks, you buy toilet paper, focus on price and yield. Fantastic. That'll stick in people's mind.
I forgot about that. Yeah, and then for the young people, I do speak to Title I schools, and our clients, we meet with their children because we want them to be engaged as well. And I go back to what Peter Lynch said: you buy what you know. And so it doesn't always work. I have one young client. I mean, most of her investments have done really well. The airline she selected did not, but investing is about being mostly right. And so there's a season for every stock, and I show examples of that, like stocks I bought that went down a lot and then what they look like today. And so I just talk to them about doing their own research, because you can do that now, there's plenty of data, and buying what they know.
Yeah. I think one of the things that every good advisor says, it's a long haul game.
Yes.
You cannot beat the market by trading. I'm sorry. Unless you have the supercomputers that do it in fraction of a second yourself, you're not going to beat the market.
And they're not even beating it. I mean, most
Yeah.
hedge funds haven't outperformed the market for decades, but there's a chart I put on page 6, which is time in the market versus timing the market. And it shows what happens when you miss the 5 best days out of a 25 or 30-year period. It's almost
Yeah.
30 years, 29, I think.
Yeah.
And it's crazy because your return, if you just stayed fully invested, would be 8% annualized during this time period. If you missed the 5 best days, it goes down to 6.2% annualized. So every year, just for missing 5 days, you give up 2%. And if you think about the compounding of that over time,
Mhm.
it's a lot of money. It could be
Yes,
millions of dollars.
yes,
So,
indeed. The snowball at the top of the hill is going to get a lot bigger than the one halfway down. We understand that. Yeah.
amen. Yeah.
And I love this line. I mean, by the way, for people who think, "Oh gosh, it's going to be dry," no, no, this is a fully engaging book. One of the lines I like in it, and I'm going to quote it to you. Repeat after me. I will not listen to the stock opinions of friends or anonymous investment experts. Full stop.
Because I've done it. I think then I give you the examples of all the mistakes I made so that by the end of the book, you're like, wait, why am I reading this? If she's, is she the expert? Yeah, you can't because people lie, first of all.
Mhm.
I think, the wasn't a sitcom, but the show House.
Yeah,
He always said patients always lie. I think investors lie a lot too. Yeah, but it doubled, but then they don't pick up the lunch bill
yeah.
when they're telling you about this great stock they had that doubled. And if you don't understand the company, you're doomed to failure. And that was the mistake that I made a few times, where I just took a tip because I thought, yeah, this will be great. It'd be a great quick turnaround, and I lost everything.
There aren't quick turnarounds. I mean, there are, but not for the likes of us, unless, yeah. And even as you say, the pros use it too. Here's another point that I thought was really on point was, so when we buy clothes or furniture, even our first car, we aren't often in a position to buy the very best because the budget just won't take it. But when we're buying the stocks we want to own for a lifetime, buy the good stuff.
Yeah, exactly. And one of the examples I give is Starbucks, which I bought in April of 2007. This was after Howard Schultz had left for the first time, and the stock tumbled because they stored everywhere.
Yeah.
And so it got down to a level that was attractive to me at about $30 a share. I bought it. It went up almost immediately because he came back. And then we had the great financial crisis, and it went down to something like $5 or $6 a share from 30. And at that point, I was retired. I was driving carpool. And when those statements came in, I just chucked them in a drawer because I knew I'd do the wrong thing. So
Mm.
I didn't open them. And so I didn't buy more, but I
Uh,
didn't sell it. And it's up something like, I was just going to try to find the exact number so I'm not making it up. It's averaged since then, August of 2007, an annualized return of 14% per year. So
Sweet.
after going from 30 down to $7.17, it has returned 14% a year, and the S&P during that period is up 8.4%.
Yeah. What,
Great companies.
yeah, indeed. I want to circle back to what advice you would give to a 10-year-old, because that's one of the questions that you suggested we ask.
Yeah, so I think when I did it with my kids, we sat around the dinner table and we talked about the products they liked and the reasons for investing and why it's important to, compound and stay ahead of inflation, why dividends are good. So, and I got some of my best investing ideas from my kids because they're thinking about things that maybe you and I are not yet quite hip to.
Yeah.
And so we do that. And then when we go to the store, I'd say, okay, you can buy we bought General Mills, so you can buy General Mills cereal. And so they would then, look at, oh, okay, this is important. I have to like the products of the companies and the service that they provide. So we just broke it down real easy. They both had investment accounts and they made some of the decisions. I made the rest.
Interesting. You made an interesting distinction between people who produce goods and people who produce services. Does that come into your play when you're looking at the market yourself?
Yeah. So right now, for example, I think the market is analogous to the 1990s because there's a labor shortage. There's a whole bunch of reasons, but I
Yeah.
won't go into too deep. But there's a labor shortage, and what do companies do when they can't hire people? They spend money on technology, which is software as a service. Of course, some chips, which are goods, but particularly now with generative AI and cloud computing. So you want to be thinking about having exposure across sectors. And I talk about that in the book.
Yeah.
What does that mean? What is a sector? You don't want to buy everything in retail.
Yeah.
Just because you like retail. At one point in my life, I bought Tiffany when it was an independent company because I just loved getting the Robin's Egg Blue annual report in the mail, and it kept me from going there and spending money on it. But money
Yeah.
on the products. But yeah, so I think it's just important to think about all aspects of things you utilize. So, airlines are a service, software, so on.
hmm Which makes me wonder, just out of curiosity, totally irrelevant to anything, do you watch Shark Tank?
No,
What's interesting is that there's a copy of a British program called The Dragon's Den. And I've watched both, and they're pretty fantastic.
I know people love it. I just get really uncomfortable when they're rude to people. So,
Yeah.
and I've had a day's worth of financial news, so I usually, switch to something a little lighter.
And you make an interesting point here. You say the vast majority of Americans are capable of saving, but they lack discipline.
Yeah, I was one of them.
Yeah.
Yeah, and I opened the book with two purchases I made and this was also in the first edition in the same week. And one was an $1,100 sweater in 1980, cashmere. It's all bally and has mothballs in it, and I still have it. It was a purchase I made. I was in a hurry. I didn't even look at the price. I didn't even know what cashmere was. And then I bought a share of stock for my son. And it was right. He had just been born, which was why I needed the sweater because I was going to a business meeting and it needed to
Yeah.
cover. And so I talk about the opportunity cost of having bought that sweater and not investing the money, and then showed the value of what would happen if I did invested more into the share of stock I bought for him. It's not about living a Spartan lifestyle as much as it is about stashing away whatever you can. Like I would get to the end of the month, with kids and sports and all the expenses, and I'd say, it's only a couple $100. I'll just spend it. But if you save, 50, $200 a month, and you're investing it in stocks, which now you can do in fractional shares. So
Yeah.
back in the day when I was investing, you had to buy 100 share lots. You
Yeah.
can buy 1/10 of 1% of Chipotle, or Broadcom, which are trading at over $1,000, and you can build that and reinvest the dividends, and it will make a difference over time.
Yeah, I can remember the time when you could only buy 100 shares, and I'm
Yeah,
sorry I can't get that Microsoft stock today because
right,
yeah. I,
right.
interesting aspect to that is the fact that well, I'm going to throw a different direction here. Difference between A lot of people don't understand the difference between a exchange traded fund and a mutual fund.
Yeah. So I've run both. We have an exchange traded fund. It's the ticker's TGLR for my name, which I hate. But mutual funds really frustrated me when I ran them because at the end of the year, the fiscal year, the mutual fund distributes capital gains to the remaining shareholders, and so you get this taxable event that you didn't get to plan for. And the worst is when the market's down and you get the capital distribution, because remember, when investors are fleeing the funds, the portfolio manager has to sell stocks. They usually sell the good ones that have done well, and so there's been a number of times in the last 30 years where you have a negative return, but you get hit with a huge tax bill because they distributed capital gains. Plus, you buy at the close of business. So if I make a decision to buy a mutual fund today, I don't even know what the price is until tomorrow. So I think the illiquidity and the way that the net asset value is calculated is a little bit old school. ETFs, or exchange traded funds, they trade like a stock. So they have second by second, minute by minute pricing. They're tax efficient. And I can't explain on in this environment why, but they use baskets of securities. So you're not taking the kind of gains that you take in a mutual fund to when assets come in and go out. And so they're very tax efficient, and the fees are generally significantly lower. So it's a great way for women who are super busy and they go, well, I really love technology. I'm going to buy the QQQs, or I'm going to buy another technology ETF, or I just need a basic equity strategy. I'm going to buy the TGLR and watch the dividends grow. So there's a lot of different ways that women can get where they need to go without having to become stock experts, but still be in control of their investing future.
And I think the fact that the strategies you outline in the book will give them a lot of comfort in having that control. And I think that's part of your motivation here, isn't it?
Yeah. And I think it's fun to own individual stocks because it gives you an attachment to your portfolio. But importantly, women really do make excellent investors. And the research, time and again, when I wrote the first edition, there was one study. It was the Barbara and Odine study that showed women, and it was a little bit old even then, but they averaged about 1% per year over 10 years, better performance than their male counterparts. When they were compared against single men, they averaged about 4% more. And the reason is that men tend to be very competitive. I mean, I am too, so that's not a criticism, but
Yeah.
women tend to invest for an event or, for just return, but not beating the index. And so they don't turn over their portfolio as much and they generate better returns, lower volatility. And now there's subsequent other studies that I cite that also show the same thing.
So obviously the strategy to buy and hold and ride out the troughs. Is there a time though that you think, yeah, maybe I better dump this?
Yeah.
What are the indicators for you for that?
So change of management's a big deal. It could be good, but
Mhm.
sometimes it's not so good, or a product slip up. But what you can do is you can read. I mean, there's so much free research that we used to pay millions of dollars
Yeah.
for as institutional investors. So you can read a great deal about the management team. Like think of when Tim Cook took over Apple, and I write about that in the book.
Mhm.
And he was, quote, no Steve Jobs, unquote. And so people really tested the stock price. Well, it's a good thing he was no Steve Jobs because the stock's up about fivefold
Yeah.
since when he took over the company. So, a new manager can be a good thing for the stock price. You just have to, read, watch, and use your own good judgment. Same thing happened at Amazon when Andy Jassy took over for Jeff Bezos.
Yeah.
And we said at the time, he's getting Tim cooked. And so we bought more and he did deliver. You could, and he ran the whole cloud computing business. It was his idea. He
Yeah.
ran it. So you knew as an investor, he had some acumen and that he'd probably figure out the problems that he'd been left with. So
Yeah.
that's a big red flag. But that's researchable and women are good judges of character. So
Yeah. Interesting. You notice this again. I take lots of notes and I think page after this book because it's dense in the best possible way, dense with good information. You
thank
say
you.
about 40% of our performance through asset allocation decisions and 60% from the stock selection. That's an interesting mix there.
Yeah. Right. And owning the right companies makes a big difference, which is why I go through the case study. So it's not just Starbucks, it's also Microsoft. It didn't do anything for a whole decade when Steve Ballmer was in charge, and then the new CEO came in. But in between that, they started paying a dividend. And so I began buying it and it's one of the top performers along with Apple in my personal holdings. But um, you want to own companies that you can own for a lifetime because they'll figure it out. They don't always. So remember Xerox and
Yeah.
Polaroid, but generally speaking, if you've got a management team like Satya Nadella at Microsoft, he has pivoted in all the right ways since he's been in charge for the last decade or so. And
Mhm.
so the company continues to adapt and lead in multiple industries or multiple segments of their business. So it's an important component, but also being exposed to equities. Enough exposure is important. So I cite an asset allocation study that was done by TIAA CREF, and
Mhm.
they utilized three experts, one of whom was Jack Bogle of Vanguard, two other individuals that most people wouldn't know, but they measured their asset allocation 40 years from retirement, 20, 10, and 5. And actually, the woman, Jane Bryant Quinn, she actually generated the highest performance because she took the most aggressive exposure to equities. And it's counterintuitive for a lot of women, but being exposed to stocks over the long term is what matters. Going back to that chart I mentioned early in the book.
Let me throw a smile challenge at you and tell you where are the sectors you're looking for growth at this point?
Definitely technology. Our investing theme is old economy companies that are embracing the digital revolution, which includes generative AI and cloud computing. So I just gave a speech in Florida and I showed the performance of Walmart versus Kohl's over the last 5 years. Walmart pivoted to digital. Kohl's said, hey, we'll take back your Amazon packages. That really isn't a digital strategy. And the gap in performance is about 100% in Walmart's favor. McDonald's versus Wendy's. So again, a company that's embraced digitization. Their app had 4 times more downloads than Starbucks last year. I mean, they're catching up. So it's a little bit small, law of small numbers. But so old economy companies that are embracing digital revolution, and then the suppliers of the tools. So think, all the obvious names in technology: Microsoft, Palo Alto Networks for cybersecurity, um, ServiceNow for data direction on the cloud, Oracle for generative AI, Broadcom for generative AI. So there's a lot of names that you can, Broadcom's the poor man's NVIDIA, and it's gone up about 100% this year.
I
But
love that comparison. That's wonderful. Thank you.
but it's a more diversified business that pays a dividend that they just raised it 14%, but in the last 5 years, it's been growing about 25%. That will really kickstart your total return.
Yeah, absolutely. Okay, well, let me flip that. And what's their sectors at the moment you're kind of shying away, not necessarily dumping, but not investing in?
So consumer staples are pretty expensive after the pandemic. They had pricing power. Some of those names are trading at price to earnings multiples. I define the term in the book. There's a glossary in the back.
Yeah,
Think of price to earnings ratio as like how you would look at a house price per square foot.
yeah.
It matters, it's going to be different based on quality, location, et cetera. But consumer staples have been pretty expensive, and they have pretty low levels of growth. So when you're, low single digits for the most part in terms of revenue. So when you're entering a slowing economic environment, which feels a little silly to say after we had the Fed chairman come out recently and say, we're going to cut rates next year, but this economy is slowing,
Yeah,
and you want to own companies that have reliable earnings growth.
yeah.
So yes, staples have reliable earnings growth, but they're pretty expensive. So we like some of the names in consumer discretionary more. We're underweight utilities, which have popped in the last 2 days, but I'm not convinced that's really where you want to be for the long term, even if rates do come down, because there's no growth to speak of. And then the same with REITs. We are exposed to REITs. We might be adding a little bit, but it's not a huge weighting in our portfolio.
REIT being a real estate investment trust. Yeah.
Thank you.
You
Yeah.
bet. Well, I had to learn all this stuff myself, so I'm sharing that with our listeners. Um, wow, so much information. I'm kind of at a loss to go where next, but perhaps I should ask you this: where do you see AI in the future? There are a lot of fear being sent out, and a lot of positive. Where do you land on that?
There was a great paper that was written by Mark Andreessen, and you can Google it. It's called "How AI Will Save the World,"
Mhm.
and he deals with this. The fear mongers calls them it's the Baptists versus the bootleggers. So the Baptists didn't want drinking because it was bad for you, and the bootleggers figured out how to make money on it, which is kind of government regulation.
Yeah.
Um, I think that there are a ton of applications that will be super beneficial to every occupation. In this speech I gave, I can't remember it all off the top of my head, but there was I used a Goldman Sachs chart that showed that about 80% of our jobs will be aided by AI, but not replaced by. And I think that's important to note. You hear people say, well, robots can end the world. Well, we can end the world without robots. I mean,
Yeah.
there's plenty of fingers on the nuclear
Yeah.
football button or whatever you call that. So
Yeah.
I think, there will be appropriate regulations. I think having adults in the room like Microsoft will define parameters that people will occupy. But I think the last thing we want is government regulators. They don't tend to understand technology, or they would have done something about social media a long time ago.
Oh,
Um, they,
amen to
they
that.
talk
Yeah.
about it, but they just don't have the bandwidth. And so it'll be left to the private sector, and, there'll be some bad actors. There always are. But there will, I mean, think of FTX and Sam Bankman-Fried. Does that mean crypto's bad? I mean, I don't own any, but no, it doesn't. It means he skirted all the regulations, and there weren't very good regulations. So, and people weren't doing their due diligence. I mean, there were firms, believe it or not, Roger, and this, but there were private equity firms that invested in the company to the tune of hundreds of millions of dollars. There was no CFO. There's no board of directors. I don't even know how it passed due diligence 101, but it's greed. And so there will be, some bad things that'll happen, but generally I think AI will benefit society.
Yeah. I get there's a certain FOMO, a fear of missing out on that. Oh, we got to grab it. It's the latest hot new thing. We don't want to be left in the dust when everybody else is making $1 million on that. So
Yeah. Same with Bitcoin, same with, the meme stocks.
Yeah.
And that's why, I think I really encourage people to decide what your discipline is. You may be a growth stock investor, you may be a value stock investor. They are in and out of favor. Stick with whatever it is you decide and don't chase. I think one of the investing rules is don't run with the fast crowd.
Yeah.
You need to go your own pace. Because if stocks return on average 8% a year since the beginning of time, the rule of 72s would argue that your assets are going to double in every 9 years. So that's pretty good.
Yeah, the rule of 72 is if you divide the interest in by 72, that'll tell you how many years to double your money.
Yeah.
Yeah. We have to wrap this up here, but is there any final thought that I have not talked about or mentioned you want to make sure the audience knows about?
That they can do it, that it's not mystical. Not only do I have the investing rules, I have 5 warnings of mistakes I've made. I've got a glossary in the back. And then the examples, I think, will give people a lot of encouragement, how to do things the right way, and maybe some of the things that you shouldn't do. And those lessons, I hope, will give people, the confidence to invest on their own. And you can open a brokerage account with $0 now.
That's amazing. Our
Yeah.
guest today has been Nancy Tengler. The book is The Woman's Guide to Successful Investing, Achieving Financial Security and Realizing Your Goals, second edition, highest possible recommendation. And thank you so much for your time with us today.
Oh, Roger, thank you. I really appreciate it.